Okay. Thank you. I want to welcome everybody to today's special call meeting of the CERS Pension Board of Trustees. I'm sure everybody's got all their Christmas shopping and everything done, so I appreciate you taking the time to spend a little time with us this afternoon. Eric, can you give us the opening statement, please, sir?
Of course. This is a special meeting of the County Employees Retirement System Board of Trustees. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, can you take the roll, please?
Yes, sir. Mr. Cheatham,
Here.
Dr. Carver,
Here.
Mr. Foster, Mr. Fulkerson, saw him on, Dr. Hackbart,
Here.
Dr. Milkman, Mr. O'Mara,
Here.
Ms. Pendergrass, and Mr. Powell.
Here.
Now, I will notate that Mr. Fulkerson is on, so.
Hello.
Oh, there he is. No problem. Just wanted to make sure you didn't have any issues with your computer. Thanks.
Okay, thanks, Sherry. Is there any public comment for today's meeting?
No, sir. No public comment for today.
Okay. Well, again, I want to thank everybody for taking time today. I think this will be a very informative, very useful meeting for us. I want to thank Dave and the folks at Wilshire for making the trip down. Sorry I couldn't be there in person, but I'm looking forward to hearing your presentation. I think a lot of times when trustees come on board, they have, they're assumed to be able to pick right up. And even though most all of us have been here for a few years now, I think this is the first opportunity that we've given Wilshire to really give us an in-depth overview of what their services are, what we've contracted for, what they do and can or could provide for us. So I'm really looking forward to it. Just as a side note, we are looking at having a special call meeting again Thursday afternoon to deal with an investment opportunity. I'm not sure if we're going to have anything else on that agenda or not, but as my commitment to Dr. Hackbert stands, it certainly won't last more than 2 hours. So with that, Ed, would you like to introduce the folks from Wilshire and give us your overview of what you expect from today's meeting?
Well, I thank you, Mr. Chair. I'll do that, and then I'll turn it over to Dr. Hackbart. I'm pleased to be here with the Wilshire team. This team has been on the CERS assignment at least since 2021, I believe as far back as 2017. They have always been extraordinarily responsive to us in terms of the things that we wanted to explore, ideas that we had, things that we wanted to see if we could implement. And as the chair said, this is maybe the first time that we've given Wilshire the opportunity to open up everything that they in fact do and say, here's our services, here's our service platform. You're currently utilizing this, but there are other things that could be utilized. So I've gotten to know these three gentlemen. I just met Ian earlier today, and he's going to have a very particular role today. But I just want to say thank you for the commitment that they show. They always, whenever we're having a meeting, they always ask, should we attend? That's the level of commitment that we've got from our investment consultant, and I just want to say thank you for that level of commitment. Dr. Hackbart, I'll let you lead us into what it is that we're going to speak to today.
Well, thank you, Ed, and you were doing a very good job, and you could have continued it, and the value of the introduction has dropped since that you were in charge. So, but I would like to welcome our guest this afternoon. As Ed indicated, this gives us an opportunity to hear from Wilshire, our consultants, about the opportunities they have, the services they can provide, and even have some interchange about, our own assessment. Are those the services that we really need? I believe our investment staff will also be listening in this afternoon, and we certainly are going to value their input in terms of identifying the types of services which they feel are most critical and most important to them as they carry out their responsibilities. Just a couple other thoughts. This is sort of similar to a session we had maybe 2 or 2.5 years ago in Louisville, where you basically made a presentation about the services that you were providing or could provide, and with a similar intent as this afternoon's meeting. So we look forward to your presentation. So we welcome David, Craig, Chris, and Ian to this afternoon's session, and the floor is yours.
Great, thank you so much. I'll start by saying it's great to be here in person. It's fun whenever we get to do this. We've been live a few times this year, so really appreciate that. And Ed, you were spot on. It was 2017 when we started to work with you, so we will thank you over and over again for your business. It's been a great partnership, and really happy today to just walk through an overview. I think for kind of two things. One, you asked for an overview of our services, so happy to just unpack all that and show you as much as we can. But also maybe a refresher for some people, or even a first time for others, who haven't been around with us here in the 7 years. So really happy about that. A new face, Ian Leverich, who is part of XTP, which is a product that we will talk about later in the session today. We acquired this firm this year, and they are all about a forensic study of total portfolio costs, way beyond what we all, I think, have historically thought of as transaction cost analysis type of work. So we have a whole session dedicated to let Ian walk you through that. So we have two different presentations we'll go through. We'll probably spend maybe 60 minutes or so on this first one, but that's just kind of a guideline for us, really, because we hope you're as interactive as you want to be and talk about any of these things. We're happy to drill down. We can drill down today. We can drill down in another session, however you like. So, and we also have on the screen with us Mark Friedberg and John Patterson from our private markets team. So about half of this opening deck, they'll walk us through that, and everyone you're looking at has been, except for Ian, has been part of your team since the beginning. So that's just been exciting for us. So a little bit, like to start at the real beginning here, Wilshire, and for anyone who is sitting around saying, well, who is Wilshire and how long have they been around and what have they done? 1972, we got our start. So we are about a 52-year-old investment firm, and we went 49 years with our first generation founder, and we were able to retire him 4 years ago now. We're coming up on that at the end of this year. And so it's all of us here, we're part of that era, and many of us for a really long time, and we're all part of this era. Most of us that you're talking to today were equity holders in that era and are equity holders today. I've been with us for 23 years. Chris, I think you're somewhere around
20, almost
my
25.
time, 25.
So are you an ESOP or?
No, we're an LLC
Okay.
today, yes. Mark Friedberg on the meeting with us, it precedes my time. He's 25 years or more. Probably Craig came in right around 2017. So just, a good history with all of us. But the great thing is that we have, in this second generation, we've been able to invest aggressively in our business, trying to, if you think about it, it's what a lot of firms, I think, would do after retiring a first generation founder, and then you have all these equity holders that are active in this business, and then how do you go forward? And that's what we're doing. We're just investing in the business. The XTP that we'll talk about today is an example of this. That we're able to acquire this firm, and we'll talk about why later and why we think it makes so much sense for us to hold that business. But secondly, it also we've also been investing heavily in the ability to create solutions for clients. So we're not just sort of consulting firm, asset management, et cetera. We really create a lot of custom solutions. So we'll talk about that as we go through these materials. Just some of the numbers. We advise on $1.4 trillion in assets today. We manage with discretion $121 billion. And this comes in all different forms. Some of that is traditional outsourcing of total fund management. A lot more of it is a lot of custom work that we do. Mark and John on the call with us are really close to this with our private markets business in creating solutions, whether they're discretionary or advisory for clients. We do a lot of different things, but we've had a lot of need for clients to have certain things managed, but maybe not everything. So we'll talk about that a bit more as we go through. But we serve certainly some of the largest institutions in the world. CalPERS here in the United States has been our client since sometime in the 1980s. So, really long history with large public pension plans, the exact space that you sit in. And we also serve the advisor intermediary market, which are financial firms who, in fact, actually it's kind of interesting, and there's a lot of press today about wealth management and the proliferation of wealth management in society today and in our industry. And also you've seen a lot of mergers, acquisitions, et cetera, where advisory firms that have served the institutional market are starting to connect up with some of these groups that serve wealth management shops. What's interesting is we have, for more than a decade, have served a lot of those firms, but sort of like in a white label sense, in that you may not know that it's Wilshire doing X, Y, and Z behind the scenes. So anyway, that's the industry has really shifted a lot in that fashion. We've done this for a long time, and so we're trying to create solutions across the board for our clients. In terms of just our footprint, we have 5 offices in the U.S., 2 in Europe, 2 in Asia, and 275 employees. 90 plus of those are investment professionals, 70 people doing manager research, and the broad solutions category, if you can read that on the right side of the screen, that's sort of high level of the things that we bring to you and to our clients: investment strategy and research, manager research, portfolio, risk management, tools, etc. So we'll go through a lot of this today. We'll try to just quickly comment to your points in the opening, Ed, about what we do for you. We'll comment as we go through there. We do this for you today, we don't do this for you today, that kind of thing, just so you can have a sense of that. But again, we can drill down on that at any time. But 50-plus-year-old firm, we've been doing research since day one. The firm got started in the early 1970s, and it's been research and technology and risk management. Those have been the really heavy drivers of our DNA, and that has not changed. 40-plus of those years, we've been advising institutional investors like you. 20 or more of those years, we have been managing assets, as I said earlier, in different ways where we have discretion, and more than 20 years, we've been extensively involved in alternative investments on both a discretionary basis and advisory basis that whole time. So that's just a little bit sort of that background. Institutional solutions. So the actual institutional practice began in 1981, and I think the best thing to say about this is that if you look at today's marketplace, there are a lot of firms that are either advisory only, advisory meaning advisory without discretion, or they're discretionary only, and it's outsourcing or it's not. And we really are much more of a spectrum from one extreme to the other, in that we're not trying to be just an advisory firm and we're not trying to be just an outsourced firm. But I think for a number of years, and particularly these last several years, we have seen an increasing demand for hybrid solutions by clients and prospects. And that's led to a lot of what we have today. So we have a few comments on this next page about our discretionary solutions. So this is one of the areas where we are not doing anything for you today on a discretionary basis. Just to make a few points about this, it's a very open architecture format, in that everything we do in the advisory manner, we do similarly if we have discretion. We are looking for best practice providers of asset management, asset classes, both public and private markets. We are not about bundling up things and having it be a big Wilshire suite of services. It's open architecture. In terms of flexibility, as I mentioned, a lot of organizations have some kind of a need in between an outsourced model and a fully advisory model. And that is often just creating an account or two that we manage with discretion for a particular part of the portfolio. So a lot of times that's the case. Oftentimes, an organization will want to have certain things managed, but they might have several relationships that they want to change nothing about. And so the point is, this, for us, it's about creating solutions. We just try to meet every client with what they need, wherever that is on that spectrum, and we're not about trying to pound one end of it or the other. So a lot of opportunity there. Scale, one of the things I will say, any place where there is use of our discretionary work, there are often fees that can be achieved that would not otherwise be able to be achieved, because we have a different level of scale that we can bring to clients on a discretionary platform. So that's important. And also operations and governance. If there are areas where we do take over a delegated responsibility in those areas, there's what comes to you as well as a real robust operations team and process and governance, in the sense that if we have discretion on anything, it's overseen by the entire Wilshire Investment Committee. So there's not any, you don't get the group of us here and starting to manage things for you. It's a very centralized and socialized process within our organization. So a lot of governance around that. So that's kind of the high level, I think, and we'll talk through some of the other areas where you might know about us, but we're not doing that, practicing that here today.
Great. So as David mentioned, Wilshire has kind of turned into investing in the services that we offer our clients. And everybody, I think, is aware, that, or maybe you're not, but the Wilshire 5000 is one of the oldest U.S. market indexes, and it was really intended and built to be a comprehensive measure of the U.S. market. So 5,000 came because there used to be actually 5,000 securities in the database that created that index, but through the consolidation and buyouts of other firms, obviously that's shrunk down, and I think it's just over 3,000, somewhere in that ballpark today. But when Wilshire was acquired, and the CEO at the time, Mark Makepeace, he had a long tenured history in index creation, working with FTSE, and he actually, we kind of co-branded with FT, the Wilshire 5000. We went through, if you look at a lot of the US indexes, or even the non-US indexes, fixed income markets, a lot of those are methodologies that probably have been around for decades at this point. And so our index team really kind of took a comprehensive view and really attempted to build a better mousetrap, for lack of a better term. So they've gone through looking at various market segments where there were either gaps in the market to provide indexes, improving upon old methodologies to provide what we think are superior indexes. And a couple of items on the right-hand side there pull out some of those indexes that we've done with the rebranding of the 5,000 index. We also had the Wilshire Liquid Alternative Index Series that we released, the Wilshire Risk Parity Index Series, which is more of a risk-balanced approach to investing. So using leverage to get more fixed income exposure to balance off your equity your growth exposure. And then the Wilshire Real Estate Index Series, those were kind of retooled as well. We also released the Wilshire Digital Asset Index Series. So everybody knows how Bitcoin has performed this year, but there are obviously various different digital assets that actually can be included in an index series, and we've built that to be a benchmark as well. And that's really a source of investment for the firm, where we have gone above and beyond, I think, to try to address those areas in the market. We've been very aggressive in trying to go out to folks that are using some of the competitor indexes. Index pricing has become very, very expensive, quite frankly, recently. You see a lot of these firms almost have a monopoly in certain areas. And so we're trying to get the message out that we have built indexes that we think are superior. We're willing to be very aggressive on the pricing structures with those, and trying to build that, as another area of business that we can be competitive in the marketplace. David talked a little bit about Wilshire having a risk management tradition, and over the years we really have helped clients across a wide spectrum of some of those topics. And just going back through this year, we did have a governance presentation where we did try to lay out a framework that we kind of feel is a good framework for governance within a public pension plan. But as you look through some of these bullet points, it might bring up some of those topics that we talked about. For example, we talked about some of the risk lenses that we have developed that we use with a lot of our institutional investors, and we've built through the asset allocation process different metrics that will help us understand risk within the portfolio. For example, the growth factor or the inflation factor, so we can understand where there might be sensitivities in your portfolio or even blind spots in the portfolio that, given a certain market event, you might have more dramatic outcomes. So those are areas that we've tried to help kind of build risk management policies and procedures. We also have we work with clients to create optimal risk budgeting strategies. So when you think about that, that is a lot of times we'll look at a particular asset class, whether it's public equities, fixed income, and we'll build tracking error targets around that so that your investment philosophies can be portrayed through those specific targets. In areas where the market is more efficient, you might deem that you don't want to take as much risk in those areas, and so you're going to have a tighter tracking error target to those. Areas where you do feel there's more inefficiencies, you might be willing to take more tracking error. And a lot of times that's just measured on an ex post basis. But that's something we'll help clients kind of dial in and make sure that we get in a relatively representative view of your own investment philosophies.
And that's consistent with how you've managed assets here historically, at least as long as we've been part of the team here and watching that. You have taken more advantage of areas of the market that are less efficient, where we expect active management to work and have higher probabilities of success than it does in areas that are highly efficient and hard to outperform in.
The third bullet point, when we're talking about identifying and mitigating unintended and uncompensated risks, and this we've done some of this for you when we think about where you want to be able to be potentially either country agnostic or representative of the actual market cap weighted index. If you want to be roughly split between US and non-US to the market cap weighting of the index, which we would argue is the starting point for any portfolio, and then you might want to take tilts off of that based off of valuations. We help clients build those types of tilts into the portfolio. We do have through our CIO and a committee that actually meets every quarter to develop Wilshire's house views on different pair trades. So we might look at US markets being perhaps valuation heavy, very expensive. Non-US markets might be a little bit more attractive. We might take positions there. We're currently not making any positions there today, but one position that we do have, for example, is we do think valuations are very rich, so we've become a little bit more defensive in nature in our portfolio. So we've actually put a low vol or a minimum volatility overweight compared to the market cap weighted indexes on that. So we're becoming a little bit more defensive in our positioning. And we'll work with clients to share those views anytime that they want to dig into those. We're happy to share those and kind of dig in, and we can even arrange a call with our CIO to rationalize those and talk about those through further if anybody's interested.
And those should be, if you're on our broader email distribution list, you're getting those. I don't know if you've taken the time to look at them, but they should be coming to you. But they're also available on our website, so you can go right out and see those at any point.
And those pair trades, those can span across various asset classes. And so one that was actually in the Kentucky portfolio was that shorter duration position when we had interest rates that were near zero, and we thought fixed income was a very asymmetrical trade. Kentucky was actually very proactive in shortening the duration of the portfolio, and that would be the same type of that would be an intended risk that you're taking, and that's not something that we would look to mitigate out of the portfolio. That's an intended risk. Whereas if you were taking growth bets within the portfolio as far as growth versus value, and those were unintended, we may want to mitigate those a little bit. So those are all things that we can talk through, and we have different risk models, style models, attribution models that help us kind of uncover a lot of that information. And we're happy to speak with the board, the investment committee, the staff on any of those.
So much of this, this is kind of split in terms of, is this part of what we do for you today, and is it not? So a lot of what Chris just talked about is happening as we work with your team and staff on investment structure of asset classes, et cetera, and even in the rebalancing, ranges in the investment policy, et cetera. But some of it, one of the things that we do not do here is, it's on, I believe, the next slide, where we talk about our dashboards that show a lot of risk metrics that you can step through a little bit. But that's something. So a lot of this is happening naturally if you work with this. The risk management dashboards are something specific that some clients have wanted to engage further, and so we have engaged that part of a service model as well.
Yep. So the investment structure, optimizing manager structure, that's something as we go through and we're looking at fixed income equity, we do have very specific models where we look to optimize based off of the manager's idiosyncratic risks and returns that we model within the portfolio. So this is something we did some work with Brian a few months ago to review the fixed income composite, and that's something that Joe and I are looking at right now within the U.S. equity composite, and in 2025 we'll be doing a review of the non-U.S. equity composite as well. And we do a lot of heavy modeling there to produce alpha assumptions. Those alpha assumptions take in Wilshire's manager qualitative research. So we have over 70 investment professionals that are actually participating, contributing to our manager research efforts. About 20 of those folks, that's their day-to-day responsibility. That's all they do is meet with managers and build those evals. But then the rest of, when you think about Craig, David, and I, when we're going to meet with managers, we'll share our notes and our thoughts with the manager research team, and that all gets encapsulated in our manager research rankings. And that's something you absolutely have access to today. So anytime we're doing a manager research, or if Steve were to come to us and say, what do you think of XYZ manager, we'll have rankings on those managers, usually at the firm level and then at individual strategy levels as well. And then ultimately, we want to be able to distill this down so that the investment committee and the board can digest all of this information. So we work with you when we first onboarded the relationship to build performance reports. I think one of the ones that Steve does a really nice highlighting every single quarter is looking at the total fund return risk, and then he also has the Sharpe ratio on there as well, which is a measure of how efficiently are you deploying your capital on a risk-adjusted basis. And that's something that Kentucky has always ranked very highly in. And then the next page, David touched on it just a little bit, Wilshire started out, as David alluded to, as a research and analytic firm. And we built global and fixed income risk models that we still continue to use today. We've partnered with another firm, Clearwater. They have taken those risk models and they're in the process of putting those into the next generation, if you will, of that version of the risk model. It'll be all online, but we use those engines, which are tried, true, and tested, to really implement or to upload the holdings into the system to be able to dig down at a very specific level to understand drivers of risk within the portfolio. If you were to blow up some of these charts, they're actually interactive, so we can look at how much tracking error is coming from a particular strategy within an asset class composite. Within that particular strategy, is that manager's risk coming from specific factors that we have defined in it, or are they idiosyncratic in nature, which ultimately you'd like to find those idiosyncratic, that they're unique to the managers, because that's ultimately what helps diversify the portfolios. And so this is a service that you're not taking advantage of today, but it is something that we could talk about in the future if there was ever a desire to give staff the ability to have this type of click-through ability and drill-down ability into the portfolio. With that, I'll turn it over to Craig.
Thanks, Chris. So with that discussion of risk, this page might look familiar from the governance education we did over the summer. It's important to highlight that risk management is different from risk avoidance. So we want to identify and understand the risks we're taking and determine where we're getting appropriately compensated for that risk. We're not seeking to stick our head in the sand and avoid taking risks, because we need to take risks to achieve the returns that we're trying to generate. So I'll move relatively quickly through these next few pages. These are examples of what I guess you call the bread and butter of what we do for you, and services that you're surely more familiar with. So on the next page, a little bit more detail on our risk assessment framework. We want to look beyond just the volatility of your portfolio and consider other types of risks that you face. So we spent a lot of time in that education over the summer talking about behavioral risk. So making sure you have the governance procedures and policies in place to manage that risk. But then the other risks that come up at different parts of the process, inflation, liquidity, that would be something that would be heavily focused on during an asset allocation and asset liability process, which we also went through recently. So making sure we have a mixture of risk exposures to not just exposure to economic growth, but inflation. You'll remember that we show a bubble chart of different regimes of rising and falling growth and inflation. We want to choose asset classes that will provide some sort of beneficial return stream in each of those to come up with a total portfolio that's as balanced as we can get to those different risk factors while still achieving the returns we're trying to achieve. You see your active management risk, like Chris mentioned. We call this structure analysis. You look at an asset class. The asset allocation tells us, for example, we're going to have X percentage in U.S. equity. How do we structure that U.S. equity to not only get us the intended returns that the asset allocation was trying to allocate to, but to do it in the most optimal way? And what amount of risk do we want to take relative to the benchmark there? As Chris mentioned, in certain areas we want to take little risk because the market's generally efficient. In other areas, there's more opportunity to add value. So we might be looking to be more aggressively deviating from what the benchmark is to try to capture those excess returns. On the next page, this is another chart you would have seen over the summer in our asset allocation studies, and probably at least in one presentation we make every single year to you guys, this focus on decisions that matter. So objectives and asset allocation being the largest two components, as we talked about when we went through the asset liability study. The asset allocation process is driving the vast majority, 90+% of your return. So that's a big strategic decision we want to revisit every few years. And then the other decisions from there help us fine tune and hopefully capture additional returns and alpha beyond that. So if we skip forward 2 pages to structure, again, investment structure is a level down from the asset allocation process. It's just like asset allocation, but at the asset class level, and instead of the absolute risk and return space, it's relative. So you're measuring the expected excess return and excess risk above the asset class benchmark that your portfolio will build. So when we're looking at this, for example, in core fixed income, which Chris mentioned we reviewed with Brian earlier this year, you're taking very little active risk and expecting very little active return as a result, because when we model the different potential solutions we have there, it's a case where you quickly see diminishing returns on the risk you take. So at a low level of risk, you can expect, say, every 20 basis points of risk to give you 10 basis points of return. You move out to 50 basis points of risk, you're not getting 25 anymore. It's more like 12 or 15. So that there's a diminishing return as you move out the risk spectrum. So finding that level of risk that not only are you comfortable with in terms of the tracking of your portfolio, but where you're maximizing the payoff in terms of adding risk and getting a commensurate level of return, that's something we key in on in that process.
And that's something, as we talked to Brian when we did the structure review, your fixed income sleeve of the portfolio is really your investment grade fixed income. So that's kind of more your safety bucket. There's not a need to go too far out on the efficient frontier for that particular composite, because you do have your specialty credit and your high yield bucket, which is really where your higher octane yield generating, higher returning managers are going to sit in the portfolio.
So then just a couple more pages, our manager research process, as Chris mentioned, the 70 plus professionals, subset of those dedicated on doing this exclusively. We use our Wilshire Compass database to start off as a point to, as you can see, screen down as we go to really hone in on our top high conviction names within any given asset class. And this is an example of something, like I said, it's the bread and butter of what we do for you, but a lot of this happens behind the scenes. Chris and Joe last week visiting managers in New York and Baltimore. That's at the later innings of a search that started with the screen of a database to find managers that exhibited the attributes they were looking for, then comparing that to what was scored well by the Wilshire research team, firms that Joe was familiar with from his time working in the space as well. This is meant to be a very collaborative thing where we can bring our resources and research to bear and team up with staff and augment what they're doing to hopefully drive a strong process where everyone's on board when we get back to this board and have a presentation. There's a lot that's going on behind the scenes from Wilshire and from your staff to get it there. And then on the next page, just quickly to echo on the performance measurement side, like Chris mentioned, we've gone through several iterations of your reporting. We seek to customize it to best fit your needs. It was probably a couple years ago now where we started producing what we're calling the board summary, which is usually what we present to you now, because coming and adding 200 pages to your book doesn't really help anybody. So we distilled it down to roughly 40 pages a quarter that are the pages we're going to spend the most time on. So we are open to work with staff or directly with you guys whenever you want to try to key in on certain specific things and figure out how we can best report them to you. Right now, actually, we're looking at creating some custom peer groups. As Steve mentioned on a recent call, we're comparing your performance to a broad peer group of public plans. There's a wide variety of plan types and sizes in there. So we've got plans that are 50 million up to $100 billion. So we're looking at producing customized subsets of that peer group that are more relevant to each of your plans. So the smaller plans might have their own subset that look at plans, say, if you have a $10 billion plan, we might look at $5 to $15 billion plans and really key on what your size equivalent cohorts are doing while keeping that broader universe as a data point as well. So again, that's just one example of someplace we can customize, and happy to work to try to find something that's delivering the data that you can actually draw conclusions from.
Craig's point about the board level summary report, those vary quite a bit across our client base also, because so many of them are accustomed to whatever that client's needs are at like wherever that gets reviewed, board or investment committee or staff or whatever that is. So, the point is we can make them as short or as long as we need to, but there's a lot of good detail in there that we can customize in any number of ways.
Right, and with the recent changes to your IPS, there's some new reporting requirements. One that stands out probably the most significant would be this annual asset class review. So we've put together an example of something that draws pages from existing things that we already have off the shelf and a few new pages, and shared that with staff, and we'll work with them to figure out what pages they want to add, what they want us to produce to hopefully come to a final product that's concise but delivers a good annual overview for each of your asset classes. So when something happens in an asset class, you already have the larger context and can jump right into the details instead of having to start at 10,000 feet and work your way down. So that's the rationale behind that requirement we put in the IPS. And question?
Just general question, three maybe, but one thing I've always been curious about, do you have a service whereby when you meet with us, you may start your presentation about issues that you've identified looking at our performance that we ought to give consideration to? In other words, help us focus on the issues that are out there. It's always good to have someone grade your performance, I think, and evaluate what you're doing, again, compared to our peers. Is that a service that you can provide or do provide to other clients? In other words, give us a periodic review. All the information you provide, we can consume that ourselves. But you're the outside group. Whatever you can tell us about how we could improve, I think would be valuable. If that's a kind of a service that could be integrated into your periodic presentations, I think it would be very valuable to us.
Yeah, that's something I think is definitely well within the bounds of what we do for you now, and just hearing your question, something we can try to key in on more specifically.
Green light, red light, yellow light.
Right.
Here's an area where...
Because a lot of this stuff, when we look at this peer analysis,
Right.
a lot of it is, and part of the reason we're looking at potentially having smaller sub-peer groups to drill down more to like-minded plans. Your allocation to U.S. equity essentially has decided what quartile you're falling in recent periods. So when you look at a broad peer group that has $50 million plans up to $100 billion, the bigger you get, you tend to get more alternative exposure, which has lagged in recent periods. So drilling down would be an example of saying, well, let's see what you're doing against peers that are actually living the same type of experience you are and have similar
Another
size.
example would be domestic, international equity, and so forth.
And that's where
We've been dealing with that question.
Yeah, for sure. Yeah.
that's where the data is great, right? It's awesome to have data, but you also have to look at it through a particular lens and know what the shortcoming of the data potentially could be. So when you're looking at something, let's just say in U.S. equity, and if you were going to rank your U.S. equity composite to those of your peers, you don't know what their risk tolerances are, what kind of risk guidelines that they've set for them for U.S. equity. So that can drive, very differing results within that rank.
And I'm not sure everyone really knows what the risk tolerance is.
And that's something that if
as far as that's concerned.
Yeah.
when we first started on this relationship back in 2017, one of the first presentations I could remember working on was the level of risk that we were willing to take within public markets equity specifically. And it was deemed, if memory serves, I'd have to go back to the actual presentation, but in US equity where we thought things were more efficient, we would have a much higher allocation to either passive or maybe enhanced index strategies than we would in the non-US. So it was something like 75-25 maybe in US equity, 75% that would be either passive or very low tracking error versus 25% active return seeking strategies. Where we went to non-US, that number was reciprocal, where we were going to be 25% in that passive strategy or enhanced strategy and then take more active management risk there. So if that was a reflection of the tolerances of risk that was implemented in the portfolio, that's something we can certainly revisit. As Craig said, when we do these annual asset class reviews, maybe that's a piece that we want to highlight and make sure that the board is still comfortable with those asset class targets.
I think that's a good approach. I was just thinking, for example, we're deviating from our peers. That's important for us to know. And it's our responsibility to analyze whether or not, with your assistants and staff, whether that's still appropriate.
Whether that's right for you.
Right.
Yep.
Right.
Yep. And you can always ask the question, why are we different?
That's right.
Yep. I also think
I think
about
that type of interchange can really be helpful
Yeah.
to us, as opposed to just a large dump of 200 pages of data.
Yeah.
Sure.
Yeah, I also think about the attribution analysis that is in the, when you talk about, maybe starting with a focus on what you would be thinking about today aside from all this data. The attribution analysis, I always think is really good. When it's in there, Steve presents it and talks about it really well each time, but it's just interesting, the way you frame the question. I often think it's kind of nice to start out a meeting. Okay, we're ahead or behind this benchmark, and why are we?
Right, exactly.
Do we understand it? If we understand it, great. If it's not what we expected, then
We
what's
need to
what's causing it?
adjust or
Yeah.
whatever, so.
I really think the conversation for the last 10 or 15 minutes has been around the custom peer group and how robust it will be. Because I can see being able to utilize for the board this in very unique ways. If you identified a custom peer group for our $19 billion of assets of 10 to 15 plans, then regardless of what you told me about those plans, I can go and look at the 5-year return history of those plans, look at the asset allocation for those plans, be able to make some generalized judgments about where we're different from them, and then be able to take that information to the board and say it's not conclusive because we don't know risk tolerance, but we do know that similar sized plans either have outperformed us or underperformed us given our asset allocation and other metrics.
Yeah.
Yeah, the main two toggles we have when customizing those are size of the plan and then also certain asset class exposures. So we could say, don't give us any plans with over 70% public equity because you might have a few outliers that are just letting it roll on the U.S. equity market or something, for example.
Right.
So.
We're happy to take, those kinds of questions and think that through and make changes in how we report in any ways that just, help you focus better, especially at the board level,
Right.
where you really are trying to be at a, somewhere up here on the biggest picture items.
Well, I'm kind of hearing two things, right? So Steve and I have had a half a dozen conversations on that peer group. I know he's talked to you all. We're working on that, right? So that's important for the peer analysis. But then I'm also hearing, like, benchmarking against our peers, the differences, right? So how do we accomplish both of those?
So the biggest thing with the peers is you want to make sure you're getting other plans that have the capability to invest the way you do. And what I mean by that is a $500 million plan is not going to have the same access to alternative markets as CERS. So they're not going to have the alternative investments that you will, and quite frankly, they're probably going to have public equity performance, and they've probably looked better than you over the past few years.
That's
as
been a bit of a
markets
theme
flipped.
for the last decade, actually.
So that kind of, I would say your peer group is definitely 10 billion and above. But once you put that hurdle at 10 billion, you're also limiting the number of observations you're going to get back. So we probably want to look at how many plans you're getting at 10 billion above versus how many you get if you put that limit at 5 billion or 1 billion. As you go down the market cap, chances are they might have a little bit more public market exposure. So then you start getting this noise as to are they really a peer or not. Now, as far as benchmarking them versus one another, that's where it gets really interesting because not everybody has the same asset buckets as you. Some folks will report their numbers and say public equity, and they just give us one equity bucket as opposed to US and non-US. So there can be a little noise in those as well. And then you have a specialty high yield bucket where some folks will just either have a US fixed income composite or they'll have an opportunistic bucket that maybe is some type of cross between high yield credit and private credit. So it can get really confusing and you almost need to know the plan more intimately to find out if they're truly benchmarking against you in a relatively fair way.
Okay, what's the
gets very
sample
hard.
size like that we could look at for the peers?
Like the lowest sample size?
I mean, just in terms of I don't know.
Like
if you guys-
how many funds?
Yeah,
Like
yeah,
10
like,
billion
I
in
think
the
we
lump
say
sum?
we want
300 to 400
statistically,
Yeah.
pension plans, depending on the time period. You go out in longer time periods, there's fewer observations, but I think that the total public plan universe is 300 to 400. Once you get to the, say, 10 billion and up plans, I think you pretty quickly get below 50. I think I recently sent Steve some numbers, just kind of the high level of where the breakpoints were, X number above and below, but we can dig those back up.
yeah, I mean, we're just talking, Steve's working on it, so I just kind of wanted to high
Yeah.
level. So
And I mean,
that's-
if you had 40 pension plans, that's still statistically significant. If you got down below 30 is usually a number, some people will say it starts getting statistically insignificant. If you were looking at 12 plans, I would say you probably can't put too much weight into that. If you're looking at 30, 40, 50 plans, and you feel that's more of a representative group of plans that are, of similar size to you, I think that would probably be sufficient for benchmarking purposes.
Okay, thank you.
A couple areas I think would be helpful to us, and that is in the private equity and private credit area. Obviously, a lot of innovations are occurring in that space, and information about some of the quasi-peers or peers, what they're doing, and new opportunities which are out there. I think that kind of information would be very helpful for our discussions as well. If you have, again, in terms of a vast amount of data, we can only consume so much. I learned that teaching class.
Yep. That's a good point, and we'll go through.
But these issues, I think, can really be constructive in having interchange and help us gain a better perspective.
No, I think those are really good points, and as we go through the alternatives part of this discussion,
Right. And I might be getting
we can
ahead.
talk.
Sorry.
No, that's good. We can talk about that because, there's like giving you a bunch of data or giving you, pulling from there the information.
Trends,
Yeah.
concepts.
Probably a good segue.
I was going to say, just to tie a bow on this real quick, from an advisory perspective, what you have access today is very encompassing of Wilshire's overall abilities.
Yeah.
The couple of areas where you don't have us contracted today, one would be risk dashboards, which we talked about that, and I didn't mention it, but in our history, having these risk systems and seeing staffs try to implement risk systems that can be very, very complex and can take quite a while to get up to speed on, not to mention the data that needs to be loaded on a maybe weekly, monthly, quarterly basis can be quite intensive. So that's something where our dashboards, we feel like we've taken that onus off of the actual user of the system. Let us do it. We're the experts in our own system. We'll load the data. We calculate everything in the backboard, in the background, and then we give you this dashboard, which really gives you the actionable intel that you're looking for. That I would say is the one area where you're not contracted today. The other one, and we've talked about this with Steve a couple of times, if there is any interest in our portfolio management software called Compass, we're happy to work with him to get access to that, and that would be just part of the relationship. There's no reason we can't give that to you.
Dave, Chris, let me make a comment and ask a question, and it might be a little bit loaded, but, with regard to benchmarking, I'm a firm believer in benchmarking, but I think one of the things that we need to determine on our end is what exactly are we looking to derive by benchmarking? Because anytime if all you're doing is benchmarking against whatever public, returns been from some of the other public pension plans, you're looking in the rearview mirror.
Correct.
Sure.
And I'm more interested in benchmarking against some of the other things that are going on in those pension plans with regard to governance, risk management, things of that nature. With that said, one of the areas that I think we all have had a little bit of concern about is what we're using for our benchmarks in certain areas. We all know we've got a problem when it comes to benchmarking against private equity. But I was doing a little digging the other day because as it stands right now, our public equity, and Steve, step in and correct me if I'm wrong, we're basically benchmarking against the S&P 500. Is that?
I think it's
No, we're against the ACWI, so it's a global benchmark.
Okay. So, I guess where I was headed is it's just that when we're saying public equity, we're lumping everything in, both U.S. and global and what have you.
Yeah, there was a point where we had separation, where we actually had distinct allocations to U.S. and non-U.S. and had distinct benchmarks for each at the total fund level. And that was changed to a global benchmark and a single allocation to public equities broadly, which is global public equities.
What was the benchmark that we changed here back a few months ago to adjust for? It was
so that was an underlying. So if you think about it, with the public equity allocation that we have is made up of a multitude of individual portfolios. Each one of those individual portfolios has their own benchmark, whether internally managed or externally managed by a manager, and that's essentially their benchmark for that portfolio. That was one of the so that was for the internally managed passive.
Correct.
That's where I want to go, and I guess I specifically want to go to where we're using the benchmark of the S&P 500. Why? What do we have another benchmark that we're using with regard to mid cap, small cap, and that sort of thing?
Yes.
For each.
Yeah, and Joe's on, and Joe, I know
Yeah.
I see you lighting up. You can speak to those as well, but it's how the construction of the public equity and the benchmark, the sub portfolio benchmark, is managed.
Right. So as Steve said, there's several strategies underneath that would be considered U.S. or non-U.S. or emerging market. Each one of those strategies is benchmarked to their appropriate opportunity set. So our large cap stuff is going to be benchmarked to a large cap. Our small cap stuff is to the Russell 2000. Our emerging markets, those are against the MSCI Emerging Market Index, but all that rolls up to our global equity allocation, which is what the policy statement has in it, is a global equity allocation. So that global benchmark is the MSCI ACWI, which is just the global opportunity set. All the individual strategies that we utilize to build our exposure to that opportunity set has their own subset of benchmarks that are appropriate for that specific region that they're investing in, whether it be in a country specific or a market cap specific.
My question then becomes, we're using Wilshire as our investment advisor, and Dave, Craig, you guys can chime in on what, as I understand it, your Wilshire 5000 index is a extremely broad-based index, both from growth and value and market capitalization and all that. Historically, the number I saw since 1975, that index has outperformed the S&P 500 to the tune of 16% a year versus 11%. Why would we, since you're our investment advisor, why would we not be making use of that index as some sort of benchmark, either in
I assume the difference there, I assume, is because of the small cap exposure. So the S&P, what you guys have used historically for your U.S. composite, I believe, is the Russell 3000. So that's more comparable to the Wilshire 5 than the S&P would be. So at the total U.S. level, I think those two are relatively
very similar. Yeah, I was going, and some of that I was thinking the very first part of your question, Lyle, about benchmarking. So what we try to accomplish is to, from a performance benchmarking process, have a benchmark, an index benchmark that for every component of your asset allocation policy, a benchmark that best reflects that component. So Steve was mentioning the All Country World Index, which is a global benchmark that consists of both U.S. and non-U.S. equity. But to take that apart for a minute, if you were benchmarking each component separately, so the FT Wilshire 5000 is a measure of the broad U.S. equity market. every security in it. And to Craig's point, so the S&P 500 is essentially the largest 500 stocks. So that would not generally be an asset class benchmark unless your asset class was chosen to be investing only in the large stocks. So as Craig said, the small cap and mid cap picks up and adds to that performance over all those years of that Wilshire 5000 versus the S&P 500. But then what Steve and Joe were outlining was that within your asset classes, within that global equity, US and non, you have lots of different mandates, and those mandates are covering all of that capitalization. So you have mid-cap exposure, you have small cap exposure, you have specific mandates for those, you have developed markets, emerging markets, and all those are appropriately benchmarked. So, in a sense, it all rolls up and creates the broad asset classes that you're in.
I understand. So my question then becomes, when you roll all those up, our actual performance, not the benchmarks, but our actual performance, and compare it up against the Wilshire 5000, how does that compare?
Well, depending on, so I don't have that in front of me, but I could say this: over the last 15 years, the U.S. equity market has outperformed just about everything else in the world. So a broadly diversified portfolio like yours it would not be expected to have kept up with just the U.S. equity market over all that time. So the Wilshire 5000 measures that U.S. equity market. That's the only reason it's on top of the world.
Well, I think one thing to note is the Russell 3000. We use the Russell indice family for our U.S. equity exposure. The Russell 3000 and the Wilshire 5000 would be very comparable.
Yes.
In their performance over that time period. And so we're kind of comparing an apples and orange if you look at Wilshire 5000 versus an MSCI equity, because the Wilshire 5000 is not giving any attribution to any non-U.S. exposure at all. And so when the U.S. outperforms, well, the Wilshire 5000 will definitely outperform the MSCI equity. It's not a comparable thing. Now, if you look at Russell 3 versus Wilshire 5, then you would expect to see like performance, which I think the guys at Wilshire will note that that's been the case. And so our U.S. exposure, I think, is benchmarked appropriately. The global equity opportunity set is benchmarked appropriately. In my opinion, Wilshire can opine, but they've not said it hasn't been since they've been on the account. So I think they'd be okay with it.
Yeah, we agree with you, Joe.
Yep.
So
yeah.
So we're open to have conversations.
Yeah, and just to clarify, the construction of the Wilshire 5000 index, it's not a trying to reflect any kind of strategy that is designed to beat some other strategy. It is literally reflecting the investment opportunity set you have in the U.S. equity market. That's all it is. It's just a measure of that. But what you're pointing out, Lyle, is the dominant performance that this market that we all live in has delivered to investors, essentially since the end of the credit crisis, with a few gaps here and there.
Given our issues with where we can place money, from a capitalization standpoint, we've had issues being able to do that. How do we broaden our base and still get a similar or better return is probably where I'm headed more than anything else.
I'm not sure I understand what you mean by broaden your base, because the Russell 3000 and the Wilshire 5000 are going to be fairly comparable from a return perspective.
I'm more specifically referring to the issue of the S&P 500, that portion.
So the S&P 500 is only being used to benchmark the large cap passive sleeve, and it was being used to benchmark the scientific beta portion. Is that right, Joe? Are those the only two S&P 500 index mandates?
Yes, and so that goes back to our discussion a while back where it was decided we want to be The U.S. markets are efficient. We want to be passive there and not spend too much fee dollars there. So we passively manage the large cap against the S&P 500. And that internal account has matched it for going back since its inception. Actually outperformed it a little bit, but in line. The scientific beta is an issue in that it is not benchmarked appropriately. So it's large cap, but it plays in the bottom portion of it. So it's actually looks more like a mid cap portfolio. I benchmarked that incorrectly when I brought it into the portfolio. So it looks ugly, even though it's done what it's supposed to have done. That being said, we're not, we think a change needs to be made there. And that's what, I think you heard them talk about, Chris and I being in New York last week. That's part of that change coming, hopefully in the first quarter. And so there's some room for improvement on the large cap side, but the vast bulk of that asset class is doing what it's supposed to do against the S&P 5, getting you that return.
And Lyle, I think maybe to answer your question, so when Joe looks at the U.S. segment of the public equity portfolio, he's comparing the aggregation of our mandates. So all the positions across all of the U.S. public equity managers and how that compares to the risks and exposures of the Russell 3 or the Wilshire 5. They're very, very, very similar. Now he has the building blocks underneath, and we've had discussions here and over time a tilt U.S. non-U.S. But if we're specifically looking at U.S. public equities, he's got the building blocks under there with individual mandates. If we wanted to go cap size tilt to small cap relative to large cap, he can allocate to more money out of the S&P index fund into a small cap manager or mid cap manager or the internal mid cap fund. So if there's a tilt there, you can have a tilt by cap. And we've also seen we've had a tilt non-U.S. U.S. just rebalancing amongst the underlying mandates of the non-U.S. portfolio versus the U.S. portfolio for reporting purposes. And that determination was made, I think, in 2020 was when we switched at an IPS level from a distinct non-U.S. U.S. public equity allocation and a U.S. public equity allocation to a single public equity allocation with one ACWI benchmark. So before those were reported separately, and now they roll up on that monthly performance report, but it's included in the information contained in the manager performance reports in the IC material.
One last question, Dave, and I'll let you all get back to where you want to head. We'll get a little deeper than I wanted to get into, but to what Steve just said, what he indicated with regard to the ability to move from one, not necessarily asset class, but one capitalization level to another. To what extent are we taking advantage of Wilshire's expertise and guidance with regard to questions like, well, given where we are, maybe we ought to be, our public equity ought to be, 20% mid cap or 10% small cap. I've missed those conversations.
So I guess was that a specific person you addressed that to, or can I chime in on that as well?
I'm just asking, you all as the investment staff and Wilshire, to what extent are those conversations going on? To what extent is Wilshire supplying,
So
in that area?
Wilshire provides a market commentary monthly that also has valuation analysis attached to it. So I look at that monthly to see how things look attractive in relative terms versus historics versus, current small versus large, or small versus its historical patterns as well. We have manager discussions all the time with our active managers to see what they're out there seeing. The tilts aren't dramatic. So, we are very cap aware. So mid cap makes up about, we'll call it roughly 20% or so of the Russell 3000. So we're going to, of that budgeted dollar to invest, we're going to be 20% plus or minus a little bit. In mid cap, we're not going to go 50 or go 0. That takes a huge active bet in the portfolio, which I don't think we're trying to do with this part of the exposure. So Our deviations are tilts. They're not dramatic. But we talk to our external managers. We look at the information Wilshire provides as we have those discussions with Steve and myself.
Yeah, and Wilshire, as Joe said, Wilshire provides a monthly valuation. It's a market analysis deck that's really good from a valuation perspective. They have weekly pieces that come out. They have conversations. To Joe's point, we do kind of a mosaic. We talk to our existing managers. We utilize a number of external resources, including external research providers that kind of give us insight into thoughts and markets, and that's a conversation that Joe and I have. I don't know how often, Joe, but it's more than weekly discussions about whether or not we're outlook for our positioning in the portfolio, whether it's cap, whether it's U.S., non-U.S., or changes that we think we might want to implement in the portfolios. And Wilshire, you may want you're feel free to add there as well.
I was gonna, Steve, you said it all, but you and Joe have said it all. I think that's a really common and good approach to that process. You have a mosaic. You listen to others besides just us. There are a lot of experts in this area. Your asset managers are experts, and we do the same thing. Our internal investment strategy committee, we have lots of outsiders that give us input in that process. So the mosaic is important. Those valuation charts that Joe and Steve are referring to, same with us. We create those and we look at those constantly. And, we recognize that winning by actively positioning within an asset class, making those tilts, those style bets, is really hard to do. And so when you see the opportunities that look extreme, that's when to take advantage of them. But your staff is careful and marginal with that, as are we in the same way, because they can go against you fast if you have big bets. So as Joe said,
and I think Joe hit the nail on the head there, is that these are modest tilts. Yeah. We're not talking about +5, +10. You might be 1% or 2%. They're not meaningfully changing the risk in the portfolio. Mm-hmm. Just taking small tilts here and there. So I think that's really what it comes down to. And the work that we do when we do structure analysis, we do model all the underlying managers within an asset class. That will give a rough target for each of those managers. And then that gives Joe, kind of an anchor point. He can kind of go plus or minus off of that.
Yep.
So if there's no other questions, we'll hand it to Mark and John to talk through alternatives.
We'll do a little bit on alternatives, and then in about 15 minutes we should switch over to our other presentation so we can talk about the cost analysis that we mentioned at the beginning of the meeting. Go ahead, Mark and John.
Great. Well, thanks everyone. Nice to see everyone today on video. Sorry I could not be there in person. We'll talk a little bit about the alternative investment capabilities that we have and some of the services that we provide across that platform. If you go to the following page, this gives you a little bit of a snapshot of what we do. We basically offer a full spectrum of strategies across alternatives, both in the illiquid and liquid space. And so throughout the presentation, I'll talk a little bit about some of those resources and some of the new things that we've been doing over the last several years, as I think we have made several advances on that front. Even later on, kind of the discussion point on some of the cost optimization with XDP is certainly relevant to the alternative side of the portfolio, and given some of the issues that you've had in the past, certainly could be additive. But an example of some of the additional capabilities that we've been adding across the firm. So within private markets, we do everything that you need to do to manage a portfolio. We do everything that could be done turnkey, from a commingled and SMA front to advisory, where we're just providing some of the tools that you need to do it on your own. And we try to really meet the needs of the plan for that. For yourself, we're doing things more on the advisory and the connect aspect, where you have some of the tools and the research, but you're doing most of the things internally currently. But when you're managing a private equity portfolio, these are the things that you have to do on the left-hand side. Whether we're doing it, or whether you're doing it, or whether somebody else is doing it, how much are you allocating? What's the strategy of the portfolio? What is the policy and guidelines of the portfolio? How are you sourcing investments? How are you evaluating and doing due diligence? How are you building the portfolio and sizing the portfolio? And then the last tier are really a little bit more on the admin side. Who is making the decision? And that's oftentimes where it differs between advisory and discretionary approaches. Just who has the discretion. Then there's the legal review and negotiation, and portfolio monitoring, reporting, and managed accounts. So we offer kind of our clients the tools to really basically to fit their needs, and trying to build up our capabilities. So we're kind of an engine that could help provide those tools or those capabilities based on those needs. If you go to the following slide, this is a little bit of a high-level overview of our platform. Wilshire's been active in the private markets area going back over 25 years. Before I even David mentioned I joined the firm back in 1999. This group, in its current kind of iteration or target, really started in about 1997. Prior to that, we had a little bit different of a structure, but we built it to be one that we cover everything from private equity, private credit, private real assets, marketable alternatives, and risk premia. We've been very active in the space. We've invested in over 500 primaries, 65 secondaries, 100 plus co-investments, and we've been doing discretionary investments since inception. Why I think that's important. It really does give us a principal mindset to investing, where we're putting our money kind of where our mouth is, and it creates what we think is better alignment, as well as better resources to deliver the tools and the research that you have, whether that's advisory or discretionary. So, if we were pure advisory, we would not have 55 investment professionals at the caliber that we do on the team, and the operations capability that we have. So we think it brings a nice level of resources and capabilities to our team. In terms of our activity, we have over 50 discretionary vehicles that we manage, and we have over 20 advisory clients, where we are currently have over 200 active manager relationships, and we sit on 70 advisory boards. So we're active in the space. We're not the largest out there. We're not the smallest out there, but we have scale and capability to be able to we think deliver excess type of returns. If you look at the following page, this is one of the areas. This is just a general market slide, but it just shows you that manager selection in alternatives is greatly important. The dispersion of top quartile to median is there's not a larger dispersion in any other asset class. So picking well, you get rewarded, and picking poorly, you get punished. And so it's very important to be selective in how you're building out that portfolio. If you go to the following slide, we like to show this as kind of a proof statement. What have we been able to do on our own on the discretionary front throughout that time? Does our process work? Are our people effective? Are we able to do what we say that we're going to do in terms of delivering that 300 to 500% outperformance over our benchmarks? Now, our benchmark was ACWI, because we're doing a global benchmark, but we've outperformed that benchmark by over 1,000 basis points over the last 10 years, and over 500 basis points relative to the S&P over that time period, and even over the 25-year time period, we've outperformed by that 500 basis points and 250 relative to the S&P. So what this tells me, at least, is that we've been effective, that we've been done a good job, and I'd like to think that we're progressively getting better. That our pattern recognition, our tools, and the resources that we're using, and the way that we do diligence is gradually increasing and becoming stronger over time. We try to deliver this level of performance, whether that's advisory, whether that's discretionary. We're very transparent. We show every investment that we're making on both the advisory and discretionary side, and try to make sure that we mitigate any conflicts through that transparency. If you go to the following slide, I'm going to turn it over to John for a second, just a little bit to talk about how we do what we do. How are we so selective? How are we looking at opportunities, and how do we show you these opportunities, more importantly? So John, do you want to just talk a little bit about our process for a bit?
Sure. Yeah, so Mark mentioned the kind of dispersion of returns between top quartile and median managers in the private market space. And so to really achieve those top quartile returns that you look for in the private markets, you need to have a defined and systematic approach to manager selection. And we've developed that over the past 25 plus years that Mark mentioned. So for us, our investment process, like most in the private markets, starts with our sourcing effort. Deal flow is a really important part of the private markets. These are not these managers are focused on deals that are not publicly traded. There's not a ton of information out there. It's not an efficient market. And so just like them, we need to focus on groups that are maybe off the beaten path, that are focused on parts of the market that have inefficiencies that they can really exploit to achieve outsized returns. And so, we're taking a significant amount of meetings every year. I think a few slides back, we show that we took 3,600 meetings in 2023. I think that in 2024, we might outpace that. I think I probably took 3,600 on my own this year at this point. But we're taking a ton of meetings with investment managers. We have an open door policy. We're actively sourcing deal flow through not only investment managers, but also through placement agents, other intermediaries, our client base, as well as other really high quality institutional LPs. And so all of that really culminates into a pretty wide net that we cast. And so the next part of our process is really identifying best-in-class managers and performing diligence and evaluating those groups. That really starts with a weekly meeting that we do internally. Our team gets together, our North American teams, as well as our European office and Hong Kong office. We get on a weekly call. We go through our internal database and all the meetings that we've taken that week. And we qualify all of those meetings into a number of different categories. But really what it does is it builds consensus around what our highest quality and highest conviction general partners or investment managers are in the opportunity set that we've built out. Once we've identified those best-in-class managers, we typically write up an investment summary that's available to all of our clients on our portal. And then we'll kick off our first stage of due diligence, which is really a way for us to evaluate investment managers and identify the key elements of diligence that we need to understand to make sure that this is an appropriate investment. We do that using what's called our radar criteria. We usually have a slide in here, but I'll try and keep it short. But our radar criteria really helps us to identify qualitative and quantitative aspects of an investment strategy, and score those different aspects across the organization, the team, the strategy, their investment process, and how they pick investments, their performance, and their terms. And we're able to score managers across the private markets on really an apples-to-apples basis, which kind of helps us to really narrow that funnel and select best-in-class opportunities. Once we've built that kind of initial phase of diligence, it culminates in really a 10 to 15 page paper that our investment committee goes through, identifies key items for diligence, and then if it progresses to our full due diligence, that will ultimately be performed with an on-site of the investment manager, ODD, background checks on the key individuals for the strategy. And then once we've discussed the full research, which is typically a 40 to 50 page paper, we discuss it with our investment committee. Our investment committee, if they approve on that investment, it goes out broadly to our client base, and they're able to see all of our research on their portal, which I'll touch on in a few slides. And then the last step is really monitoring, reporting. We're staying in close contact with these managers. Typically in the private markets in a biannual or annual cadence, and then we're delivering quarterly reports to you all on your private equity portfolio or your private markets portfolio. And then next slide, I really won't touch much on the next slide. This is more our operating capabilities and really a focus of our discretionary platform. As Mark mentioned, we have over 50 discretionary pools of capital that we manage. As a result, we have relationships with a number of high quality third parties across accounting, audit, custodians, fund administration, legal. And so we have a number of different relationships on that front, but really less of a focus for the current relationship we have now, but just highlighting the.
Yeah, and one thing I'll mention on the current relationship, we do performance measurement. So we do across the private markets and the private credit portfolio. We do a detailed quarterly report where you can kind of look at all of the metrics of your underlying portfolio.
And then maybe just touching on the next slide briefly. So this is really discussing our Wilshire Connect platform. So this is a platform that we've built out that is an interface for our clients to really interact with the private markets team in a number of different ways. So this platform really includes all of our research from our private markets team. So anything that we've done from a market research perspective gets posted to this internal platform. Any of our manager due diligence at any phase gets moved onto this platform, whether it be investment summary, our initial stage, or our final stage of diligence gets posted to our platform for you all. And then also we have some tools on here that can be useful in planning and portfolio construction. So portfolio pacing, which is obviously a huge need in pacing out the commitments that you all make, as well as constructing a diversified portfolio across the different underlying segments of each market. So if you're looking at the private equity market, building a diversified portfolio of buyout, venture capital, growth equity, and exactly what the portfolio looks like. So there's a number of different tools that you all can utilize. And I think also it gives us another touch point with you. This is meant to be an interactive site for us. So you have a direct line of contact to us, not just through email and phone, but if something comes to the top of your mind when you're looking at an investment research report and a quick question, you can just ping us through the website. It goes directly to the team here that's on your relationship. And so it's a good way to communicate without having to, get into your inbox, write up a really long email to us. You can just ping us a one-word or one sentence question on a strategy. But it's a great platform. It's something you all have access to, and it has all of our research and everything I mentioned.
And this is an area that we continue to build out. I think when we first started the relationships, we had a data site that was just a listing of all of the funds that we did due diligence on, and it was very cumbersome and it was very difficult to use. This is a tool that we've gradually built out over the last several years and continue to do and have plans to do kind of a future phase of development here as we move it kind of across our portal. On the following slide, and I think we're kind of finishing the end, so we'll open it up to questions. the overview here is, we do a full spectrum of services across really everything in the alternatives. We could build out things that are custom for you, or provide information or reports or analysis in the way that you could use. Right now, the current relationship, you have access to Connect, so you have access to all of our due diligence. We are doing performance reports. We recently, in the past, we've done pacing and portfolio construction and helped more on the kind of the build up. But as you've kind of paced off of private equity in terms of ongoing allocations for the last couple of years, really it's what we've been utilized primarily for. I think you've access to connect that database, largely for some of the real asset opportunities, and some of the sourcing. But there's a lot of things that we could do here for you in the alt space, if needed, across both advisory and discretionary solutions. If you look at the following page, just kind of another description, we do a co-investment platform. I know you guys do some co-investments on yourself, on your own with some of the managers, but a way that we've seen a lot of clients really augment their private equity portfolios, to reduce fees, to enhance performance, to get a little bit more direct. We've had a pretty solid track record on our own co-investment strategies, within our commingled funds and SMAs, but also an area where we're pretty active, and happy to kind of discuss at any future time if that's something of interest. We don't do pure co-investments on the advisory side from a sourcing standpoint. The challenge there is there's a lot of relationship access and in other issues that make that somewhat challenging to be successful. And then on the following slide, just a summary. In terms of what we do on the alt side, we like to think it's very institutional. We provide a full spectrum of what we think are fully diligenced opportunities that are very selective. We kind of pick about 1% to 2% of what we see in terms of that selection. We have flexible solutions, ones that are turnkey, as well as just tools to help you build out what you're doing, and what we think are cost effective. But with that, I just open it up to any other questions, or turn it back over to David.
Thanks, Mark.
And John? Yeah.
Can you give us some examples of those co-investments?
Some recent examples, we did XAI. So you're not going to probably hear a lot about some of those investments. So one of the portfolio managers in your portfolio is HIG. It's one of the kind of flagship private equity, probably one of the best returning series of private equity investments on the smaller middle market. You guys are investors in prior funds of their flagship. We did a co-investment in an opportunity that was investing in a company that was repairing C-130 transport planes for the military in other countries' militaries. We did XAI, which was Elon Musk's AI company that he's launching. We did SpaceX, which is recently, which is one of his companies. Those are probably more notable and recognizable, but a good majority of the co-investments that we see are deals in the portfolio that are either industrial or names in the portfolio. These are companies with $20 to $50 million in EBITDA that are probably not are less recognizable. But what we try to do is invest across very high quality sponsors that we've already underwritten or in the process of underwriting, and looking at opportunities that are unique from a risk return standpoint, that are going to deliver, trying to mitigate as much risk as possible for the max amount of return. But we've done co-investments in sports. So we did some a minority share in a baseball team. We've looked at things across almost every sector in industry, but tend to we focus more on buyout opportunities and some credit and some alt yield. That's where a lot of those kind of co-investment opportunities do come through. Some are with managers in your own portfolio. And one of the SMA type of structures that we've approached with clients is, look, you have 70 underlying portfolios, you have a staff of 2. You're not going to be able to mine and really monitor and keep track of all of those opportunities over time that are coming up. You really have to be on all of these managers and make sure that you're seeing them and that you're looking at them. And so, we've done opportunities where we could literally just mine your own portfolio for those opportunities. But that's kind of an example of what an SMA structure might be within that portfolio. And those could be even things that you have opt in or opt out type of options there, where we're not taking full discretion.
Okay. We have about 20 minutes left, I think, and we could have Ian step through unless there are other questions about anything else we've talked about, we could step through this cost analysis work that we're doing and just share that as a new service that we have as a result of that acquisition we made this year.
I don't think it's a sharing on there.
Oh yeah.
Well, thank you, David. Thank you all. It's a pleasure to be here with you. I appreciate the opportunity to introduce XTP. It's been an exciting few months since Wilshire's acquisition. I think we'll talk about how dynamic a partnership it already has proven to be. So XTP is a specialty shop. We focus on the implementation side, right? So the costs and fees that are incurred on your behalf that eat away net returns that are kind of under the hood and perhaps bandwidth constraints keep you from monitoring as closely as you'd like. Do you want me to drive? Is that easier? Or?
Either way you'd like.
This one? Okay. So just a little background on myself. So I joined XTP in February of 23. I joined from Abel Noser, which is primarily known as a trade cost analysis provider, as well as transition management. So I was there for about 17 years, and my focus was the asset owner. So my background was trying to lend transparency that was otherwise absent in the investment process, really focusing on the transaction costs, the commissions, execution costs, really on your equity managers incurred on your behalf. And what drew me to XTP was the scope, the reach of its service, and the actionable nature of the work. The pushback we'd always get at Abel Noser is, well, this is nice, it's nice to know what these costs are, but what do I do with it? So at XTP, what we do is we look not just at the trading, although it's an important piece of the puzzle, but we look at all of the costs that are and processes that are eating away at net returns, and then bring to you, separating signal from noise, where we think we can improve those costs. And we're only compensated when we're able to find measurable savings on your behalf. So we measured over $3 trillion in AUM, over 10,000 individual mandates. We've been around for 20 years prior to the Wilshire acquisition. There's about 50 plus on the XTP team. And there's a massive universe of cost data, all the way from your paid prices and your fee structures, all the way down to settlement charges. We have quantitative universe data on what is best practice and what those costs should look like. So this slide, I think, kind of illustrates our unique lane, where the unique lane they've carved out, XTP, and why it's going to be such a dynamic partnership. Again, you think about the last hour and 45 minutes that we spent, you guys are really dealing with some very important strategic decisions at a high level, talking about allocations And what we're doing is focusing on the implementation of those decisions and how your managers are running your money on your behalf. So it's an exercise in compliance and governance and efficiency. And if we can find some savings on the margins, what that does is it adds to your net returns in a risk-free manner. And again, all the risk is on XTP because we're only compensated when we're able to move the needle. Really, there's nobody doing what we're doing in this space to the extent that we are. Really, the biggest comparison you can make is a TCA vendor like Abel Noser, and that's just such a small piece of the puzzle. And you know, the other pushback that we would get is, you know, we give these reports, these voluminous reports quarterly or semi-annually, and what we find is that the results never changed, right? So a manager with high costs was a manager with high costs in the first quarter, the second quarter, but you know, you should show it to them, and there's value in showing that you're measuring them and monitoring them, but we didn't see a lot of movement. So what XTP is doing again is trying to move the needle, and on a more project basis, kind of bringing the data to a conclusion in a way that we never really did at the conventional TCA vendor. So you know, when you think about all the work and the allocation decisions that you guys are making in conjunction with Wilshire, you know, it's an extension of that work that I think when Wilshire acquired XTP, it's a really big affirmation of our value proposition, recognizing that this is a lane that, you know, your investment consultants are not playing in, your TCA vendors, and frankly, your staff doesn't have the bandwidth to focus on this stuff. And frankly, you don't want them focusing on this, you know, getting so far in the weeds when there are much bigger decisions to be made. But if we can function as an extension of your staff, there's efficiencies that can be improved.
And I'll add to that, Ian. I can tell you that we spent about 2 years doing due diligence on this acquisition because it was such a compelling thing to us. And we to this day don't think there's really competition for all of the depth that they go into. But we, you know, all of us sat around in lots of meetings for 2 years discussing this to decide if we want to partner with this. And we just think, you know, it's something that's so unique. You'll get into the details, but
yeah, and you know, our reach touches every part of your portfolio: the public markets, private markets, your separately managed accounts, your commingled vehicles, your custody bank, and really puts all of those pieces together in this big puzzle and connects the dots in a way that perhaps you haven't thought of in the past. Before we get into, you know, kind of the nuts and bolts of the analysis, what we're looking at, I think it's important to understand the process. So again, we want to function as a full service extension of your staff. So when our clients engage us, there's an agreement we put in place, and then the only other thing they have to do is send a letter out to their managers and their service providers saying, we've engaged XTP to do this efficiency study, and we'd like you to provide, you know, provide any data that they need. It's a collaborative exercise. It's not combative. So then XTP takes the ball. We follow up with those managers. We get our data directly from them. Once the data comes in, we compile the analysis. We bring it back to you when we have our findings. And again, instead of just burying you with, you know, 200 pages of TCA data, trade cost analysis, we really highlight where we think we can improve these costs. So here's what we found, and here's what we think we can improve. And then with your approval, we go and work with those managers to find solutions that result in economic improvements to your relationship. So, and we'll get into, you know, what forms they take, but the decision to pursue an optimization is entirely up to you. Many times we'll bring a finding to a client and they'll say, you know, that's good to know, interesting, but we don't want to pursue that for any number of reasons. It could be that there's, you know, on the private market side, there's a new commitment a new fund we want to be a part of, or maybe the manager's not going to cover off the ball and you kind of don't want to shake that tree at the moment. but certainly that they're not all like that, right? And if you find some opportunities that that could yield some savings on the margins, it adds up. And then we go again and have those conversations on your behalf. And then when we have explicit, measurable savings that you are able to see, then we bill only after that. And then we monitor it for 2 years to make sure that the changes were properly accounted for. So it's a project-based value proposition. Now, what we find is that our clients like the work we do, and when you add managers to your portfolio, the biggest impact will be in the beginning of a relationship, but our clients typically engage us as their portfolio changes, and what happens is they lean on us for many years.
And maybe a piece just to talk about is you don't have to do the entire portfolio all at once. You can differentiate.
Correct. Yeah. We want to be smart about your time and our time. And if there are managers that you're not interested in looking at, you don't have. That's what we would like is we'd like to think about things holistically. We'd like a mix of public markets, private markets, your custody bank. The success-based model works when there's enough for us to look at. We're not magicians. We don't find things all the time, but we find the whole firm was sustained on success-based model.
So, how are you compensated when you come forth with an idea for cost saving and it's not accepted?
But then we're not compensated. So, but usually, there's enough that we will be compensated, right?
So if you want to pursue, if there's a certain manager, public or private markets, and you just say,
for the reason we can't accept it, right?
Then we just stop, right?
Right. Yeah. I mean, it doesn't always work out, candidly, but what you find, what I've been surprised is that, it's a collaborative exercise. You'll find out who your partners are, and most of your managers are interested in hearing the data. They haven't thought of it, in this context before, and are willing to work with you, and we'll get into how we optimize. But yeah, if there's no optimization, we don't get paid.
I guess I was thinking it could be kind of institutional or statutory reason we couldn't accept it and so forth, even though there would be significant savings. We may not be able to, and I just.
Yeah, then that would be, an unfortunate circumstance.
Unfortunate situation, but they exist.
Yeah, for sure. So this is kind of how we're thinking about this analysis. So we're thinking about the total cost of ownership of an investment. So you see the costs above the line; those are what are easily derived, right? Your top line fee structures. What's below the line, again, underneath the hood, these are the things that most asset owners don't have visibility on because they're not easily accessible. So first we quantify what those costs are. So it could be soft dollars, it could be their trading footprint, their turnover, it could be any number of things that are eating away at net returns. It could be how FX is being handled. And then what we do is we look at and see if there are any places below the line that we're able to optimize. Maybe it's a cap on soft dollars, maybe it's introducing new counterparties to them that might improve their execution costs. So there are savings below the line and there are savings above the line. And the savings above the line happen for two reasons. One, again, we have this universe of paid price fee data, right? So not just the market rates that are printed, but we actually see what rates managers are charging other clients for like mandates. But also when we look at the cost below the line and we say, okay, well, you're spending $100,000 of our money or commission dollars on research, and we see your FX trading is the way FX is being handled is inefficient. Any number of those inputs recontextualizes the top line fee. You say, okay, well, we're not going to be able to change our research commitments. We're not going to change how what our trading footprint looks like. Maybe we add a new tier in the fee system. So we work with these managers to think of ways that yield a benefit to our client, and kind of after looking at this total cost of ownership, kind of how can we proceed forward? And like I said, most managers are more than willing to kind of play ball. Any questions so far?
Can you give us, some idea of what kind of savings you've been able to generate?
Yeah, it's typically depends on what your state managers looks like, what their fee structures look like. But generally speaking, anywhere from 3 to 8 basis points on the portfolio. Not per mandate, but when you kind of add up our work, it generally
You mean total portfolio size? Yeah.
Right, not at the mandate level. We're not going to find 8 basis points per portfolio, but generally the exercise yields somewhere in that range. So these are some of the components that we're looking at for the public market managers. So the implicit and explicit transaction costs. So how your managers are trading in and out of positions when they're trading on your behalf. What does their turnover look like? How many days does it take for them to get in and out of an idea? Is it a capacity issue? How is FX being handled? Are they doing standing order with the bank? Are they handling it themselves? Operational costs, as I mentioned, kind of the research spend, soft dollars. So all of these data points, and then of course your top line management fee. How does that compare to our universe of paid price data? This is kind of just a more granular look at all of the different inputs that we're looking at. Again, about 180 cost components go into this total cost of ownership, where we have, again, quantitative data. The custody analysis is a really interesting component, not just in connecting the dots between the impact of a high turnover manager when you're thinking about, how much in settlement charges are we incurring at the bank, and again, on the FX, tax withholding, tax reclaims, how that's being handled. But one of the common threads we find when we talk to investors, particularly as the custody bank marketplace kind of contracts, is most asset owners are not happy with their banks. And the banks know that it's a very big, it's a bear to change custodians. Your custody contracts become stale faster than probably almost any of your other service provider agreements, and negotiating new terms can be tricky. So this really is a quantitative means of making sure that you have the freshest rates without having to go to RFP. And some of the findings that we just had a finding last week where it's not really, it's not a nefarious thing we're looking for, but what we find is processes break down, and particularly with the custody banks, when they're doing services as kind of an add-in or an accommodation, sometimes there's some breakdowns in the process. And one of the findings we had last week for one of our new clients was the cash wasn't being swept, operating cash wasn't being swept into interest-bearing accounts. So for their managers and their operating funds. So it was creating a big cash drag. And this isn't something that is a combative conversation. It's just a tweak to the process that's going to be a couple of $1 million in savings, initially and then moving forward. And then private markets, I know we're kind of winding down on time. This is certainly where we get a lot of the interest generated right now. Obviously, there isn't transparency in the private markets that I think most LPs would like. Last year, the SEC had put a rule in place that would have mandated more transparency. We thought that was a positive step forward, and then an appellate court vacated that rule. So the GPs were thrilled; they were very happy about that. But at the end of the day, it's the fiduciaries. It's going to be always the fiduciary's job to ask the right questions. These vehicles are opaque by design. So what our team does, and what our team does, we have a team of about 20 folks on our private market team. They study the LPAs, they study the side letters, and then they from bottom up, recalculate what the fee should have been. So it's really an exercise in compliance and governance. Some of the things we find are step-down dates not being properly adhered to. So, instead of reducing that management fee after all the funds were invested, they go on charging the higher rate for sometimes months, quarters. Sometimes we see offsets not being properly taken into account, so the base in which you're calculating the fee is inaccurate. So it's a heavy lift. It's a granular forensic approach to looking at these private market vehicles. And when returns are thinner and commitments have slowed, this is increasingly something that asset owners are more inclined to want to look at this juncture. So it's certainly a big source of our growth, and the findings in the private market space can be considerable. So I'll wrap up. I know we're kind of winding down on time, but the kind of findings that we uncover can really be broken down in three categories here: non-market compliant costs and processes. So that's some of the things I talked about, whether it's trading or the way FX and transactions at the custody bank are being handled. Mistakes in calculations, not just in the private market side and how those fees are calculated, but the lowest hanging fruit, believe it or not, is mistakes in invoices that nobody uncovers. And it's hard to uncover, again, when there are bandwidth constraints, because the math on the invoice will be right, but the equation's wrong, right? And in a circumstance that you may relate to, right? If you have multiple managers running, or multiple managers running multiple mandates, not applying the correct AUM scale. That's particularly true when you have two funds with mirror investments. So that's, again, the lowest hanging fruit. Managers aren't deliberately overcharging you, but there are mistakes that happen more than you would think that our team usually finds right out of the gate. So there's often a windfall right in the beginning of the relationship. And then finally, it says we say unfavorable contract terms. Really improved. We're able to improve your contract terms based on the forensic study, the analysis. It puts you in a position to have a better conversation with a service provider and maybe negotiate a better agreement, fee structure on your behalf. Any questions? I have some examples of findings. I know we're kind of out of time here. I want to be respectful of that, but.
Ian, what's the split? Your company, our system?
Typically, our split is 50-50. We share in that for 2 years, and then we're out of it. So the reason it's 50-50 too, as well, candidly, is there are going to be optimization opportunities that you're not going to want to pursue. So when we do get a win, it's got to be, we have to share in it. And,
Sure.
All right. Well, we'd be happy to continue this in another session if you like. But I think hopefully we got enough of an overview provided in this 2 hours and different things that we're able to.
Happy to take any questions if there are.
Yeah, please.
Somebody wants to jump in.
Appreciate the time.
Thank you. Thank you.
Thank you. It was a pleasure to meet you.
Okay. Anybody have any other questions for any of the Wilshire representatives? I notice we have on the agenda a closed session. Is that something we need to do? Eric?
I don't believe there's anything that we need to discuss in closed session today.
Okay. All right. Well, I found the presentation very informative. There's some areas that I probably have some further conversation with Ed and some of the trustees about, but I appreciate your time, appreciate you making the effort, particularly during the holiday season.
Absolutely.
Ed, anything you want to add?
No, sir, thank you.
Okay. Well, if there's no objection, I'll entertain a motion that we adjourn.
I'll move.
A motion by Jerry, second by
Second. Dr.
Dr.
Carr?
all in favor signify by saying aye.
Aye.
Ayes. All opposed? Ayes have it. Again, thank you for your time this afternoon, and look forward to seeing you again Thursday, I guess.
Yes.
Thank you. Happy
Thanks to all of
holidays.
you.